As we discussed in our look at Mark Carney's negotiating stance, Canada may have more cards to play than Washington realizes. North American trade tensions heat up once again. Investors are quietly positioning themselves for a scenario that seemed unlikely just a few years ago: a breakdown in Canada, U.S. trade negotiations. With renewed tariff threats, political friction, and uncertainty around the next trade agreement cycle, several Canadian-linked sectors could see unexpected upside if relations deteriorate. Here are 3 TSX-listed players that analysts say could benefit if negotiations turn sour. 1. Rio Tinto, Rio/Alcoa, AA, aluminum producers with leverage. With the Bahrain aluminum disruption still rippling through global supply chains, North American buyers have become increasingly dependent on Canadian-sourced metal. If U.S. tariffs return or negotiations stall, Canadian-based aluminum production could become even more strategically valuable. Rio Tinto's massive Quebec operations and Alcoa's North American footprint position both companies to capitalize on tighter supply and rising premiums. A tariff-driven reshuffling of supply chains could push more U.S. manufacturers toward Canadian metal, especially as Middle Eastern output remains unstable. 2. Enbridge, ENB, and TC Energy, TRP. Energy infrastructure as a bargaining chip. Energy is one of Canada's strongest negotiating levers. Cross-border pipelines, natural gas flows, and refinery supply chains all rely on stable trade terms. If talks sour, Canada could prioritize domestic routing or renegotiate energy access on more favorable terms. Enbridge and TC Energy, which operate some of the most critical North American pipeline networks, could see increased demand for secure, Canada-controlled transport capacity. In a fractured trade environment, reliable and local becomes more valuable than cheap and global. 3. Canadian National Railway, CNR, the quiet winner in supply chain realignment. If tariffs rise or trade rules tighten, rail becomes the backbone of whatever trade remains. CNR, with its coast-to-coast network and deep U.S. integration, is uniquely positioned to benefit from rerouted freight, reshoring trends, and increased demand for North American-only logistics. A Mexico-only U.S. agreement, a scenario some analysts have floated, would only amplify CNR's importance as manufacturers shift sourcing and transportation patterns.